Hi, good evening. Okay, so in NISM learning series, okay, today we are going to check the very big concept, which is option. Okay, that is what we are going to check how option works and what are the basic of the option. That is what we are going to check as per the NISM series. Okay, let's check what happened. Okay, so in the option, okay, let's check it out. So there are two type of option we all know. One is call option and another one is put option. Okay, so the call option gives the holder, that means to say the buyer or seller, okay, the right to buy a specified quantity of the underlying asset. Okay, so you understand what is that. So let's say for example 25,000 CE or nifty 26,000 CE you are buying. That means to say you have a right to buy a that value, okay, of an underlying asset. Okay, underlying asset is in the sense what, nifty future. Okay, so on a predetermined date, that means to say expiry date. Okay, so most probably we have a weekly expiry here. Okay, so put option the same time. Okay, put option it give a opposite thing. Okay, so basically a put option on the other hand gives a holder right to buy a specific quantity of the underlying asset or the strike price, okay, at the predetermined date. Okay, this is what there are two type of option we all know. Okay, so what is call option and what is put option. Okay, so where the derivative contract exists, okay, on equity and commodity and the interest rate as well, okay, and the currencies as well. Okay, most probably. So major segment on which derivatives are traded. Okay, so where and all, okay, the derivatives are traded only in the two places the derivative contracts were traded. One is, okay, exchange, through the stock exchange the derivative contracts were there. The other one is over the counter. Okay, if you are watching the previous videos, okay, you might get to know what is over the counter. Okay, so only these two places where the derivative contracts are traded basically. Okay, so what is the impact of derivatives market, why we need derivative market, okay, in a financial instrument. So basically it will help us to improve the price of, okay, underlying asset. Understood. Okay, and valuation and expectation, basically it will help us to improve the price or volume whatever it is. Okay, and helps to transfer various risk, okay, various risk from the underlying asset. Understood. Okay, so basically it will help it's like kind of hedging. It will prevent from the losses or it will prevent from the profit. So this is why derivative is very important. Okay, so it help to shift speculative trades from unorganized market to organized market. Okay, so that is what I mentioned here. So basically over the counter market to exchange, and so these kind of things can be possible in the derivative market. Okay, so when it comes to option trading, option premium is very important because you are not paying the real value of underlying asset. You are only, okay, you are only liable to pay only option premium. So we understand what is option premium. So basically option premium is the price of the contract. Okay, so you need to pay to make the contract. That is what we call it as a option premium. So paid by the buyer and received by the seller. Okay, so acquired the right to buy or sell. So both you can do. Okay, either you can buy it or either you can sell it. So basically the price of the option contract is known as a option premium, as I told. Okay, the price of the option contract. So when it comes to option trading, okay, so there is a very big concept, okay, huge concept, open interest. So what is open interest? Open interest is a total number of derivatives or either it's a future or option contract. Okay, okay, so basically total number of derivatives. So it is a total number of F1 contract that are not closed or delivered on the particular day. So you understand what is open interest. Okay, if the transaction is completed or the physical delivery happened already, that means to say the open interest is not there over there. If it is non-delivered, okay, or not closed on a particular day, that means to say, okay, that means, so you have it over there. Okay, where they had a open positions. Okay, that is what they call it as a open interest. Either it will be a buy or either it will be a sell. So open interest is not same as a traded volume. So open interest is different and the traded volume is different. Okay, so volume or the quantity traded. Okay, so basically volume is based on quantity. Open interest is not based on quantity, it is based on buyer and seller. One buyer can buy okay, thousands of quantity as well and 2000 quantity as well. Okay, open interest are outstanding position. Okay, as I told, it's outstanding position because what is open interest? Either they are not closed or either they are not delivered. That is called open interest. So that is why it is outstanding position. Open interest tells about the depth of the market. Okay, so what is the depth? So where they have a more open interest, okay, so accordingly they will buy it or they will sell it. So based on the open interest, there are many people trade in the market. So this is a very huge concept. Most probably we will make another video from this concept. This is a only basic thing. So when we make a huge concept, okay, so we will understand better what is open interest. So there are two different options is there. Okay, it's not a call option, put option. So we all know CEPE, correct? So that, okay, so the same as well as CAPA is there. Okay, CAPA, that is what I mentioned over here. There are two different type of option. One is American option, another one is European option. Okay, American option, this is CA, okay, call American. Okay, CE, call European. PA, put American. PE, put European. Okay, so this American option contract can be exercised. Okay, so bought and sold at any time until the expiry date. Okay, but European option contract, that can be exercised only on the expiry date. So we all follow European option. Even in American market, okay, so they have a option, but that will be in a different method. Okay, that will be in a different method. Maybe if you are trading in a forex in option, you might have get to know this concept. But so we are going to focus only on this European option. So basically the same option which is followed by a European. So that is what we are following till now. Okay, and when it comes to option contract, okay, so there are different strike price. I hope we all know this. So there are three type of strike prices: in the money, at the money, out of the money, and how it calculated also I mentioned. Okay, so so in the money in the sense, okay, at the money in the sense where market is trading at. Okay, okay, so when it comes to call option, okay, so whatever inside the money, okay, for let's assume, okay, 25,000 it is trading around. So whatever inside 25,000, like 24,900, 24,800, in call option, okay, these all in the money. Whatever outside the okay, outside the call 25,000, so like 2,500, 2,200, this all out of the money. So it will be vice versa for a put option. Okay, this is what we need to know when it comes to strike price. Okay, so and when it comes to option trading, we call it as a intrinsic value instead of real value. So both were same. Okay, what a real value, okay, is equal to intrinsic value. So intrinsic value, that is basically real value of option, is defined as the amount. So when it is come to premium, okay, when it come to premium, basically, so this is how it will be calculated for a call option. Okay, intrinsic value is equal to spot price, I mean the nifty where it is getting traded, minus strike price. If you are selecting 2,500, so whatever the remaining value, that is called intrinsic value. For put option, okay, strike price minus spot price, this is what intrinsic value for a put option. Okay, so intrinsic value will be a, okay, positive. It's not supposed to be a zero. Why? Because it is a real value. Okay, real value will be not zero, correct? It will be either 1 or 2, at least 10, 15, like that will be there. It cannot be negative. Okay, it cannot be negative. And if you notice in option contract, it won't be like -5, -10, -0. Okay, it won't go like this. Okay, so basically it will be a positive value and it are zero. Okay, and when it comes to option premium, okay, time value is a very basic important thing. Okay, very important thing. So time value is the option, okay, buyer willing to pay possibility that option may become profitable prior and expiration date. Because why time value is important? Basically it has a expiry date. Okay, expiry date. And okay, and time value cannot be negative. Basically this cannot be negative. How we can calculate time value? Premium minus intrinsic value. So how we calculated intrinsic value for a call option this, for a put option this. Okay, so basically premium minus intrinsic value, remaining everything as a time value. Okay, so and how this option premium were calculated? Okay, how this option premium were calculated? Option premium is not fixed by an exchange. This is not a fixed price. Basically it is based on supply and demand. Okay, it is based on supply and demand. If any event is there, there will be a more demand will get more and the supply will get less. Okay, so the price of the premium, the option premium will be very high. Okay, if you want to say, there is a example of, okay, there is a example of last June, July, okay, when the election was going on, the option premium were too high because there are a lot of demand. Okay, So the price determined by a competitive bids and offers. Basically you see bid and ask, okay, in downside of the option contract, okay, so you might have seen it, okay. Based on that the option premium will be derived, okay. So based on this option premium will be derived. So as I said, how option premium is calculated, basically option premium is equal to intrinsic value plus time value. So option premium has a time value, okay. Why it has a time value? Because it has a expiration date, okay. And option Greeks, okay, option Greeks, so this is a very main concept, okay. So there are different type of option Greeks: delta, gamma, vega, theta, rho, volatility, theoretical value, okay. All these were option Greeks. So delta is used to measure the option premium or price, okay, option premium or price. Gamma is, okay, used to measure the change in delta, okay. So you understand the difference between gamma and delta. So basically gamma is used to check the change in delta, but delta is, okay, used to measure the change in option premium or strike price, okay. Vega is measured to estimate the option price and volatility, okay, and volatility. So using with Vega you can find the volatility in the option price, okay. And the theta, so we all know this concept, okay. This is considered as a time value. So people say that, okay, so theta decay is happening, that means to say time value decay is happening, okay. So so basically you understand what is theta. So basically this is change in time value, okay. So rho, okay, is estimated to option price and risk free interest rates. So basically based on interest rates only the option premium will get supply and demand. So basically this will be used to check what is the risk free interest rate, okay. Volatility, so basically volatility also we all know it is basic price fluctuation, either up or down price fluctuation. And theoretical value, so basically as per the historical value, and they will do the mathematical calculation, and using with that, okay, we find some value. For that purpose we had a theoretical value, okay. And who like to play in the option market, okay. So actually basically who use this derivative market or option contract market, okay. So development institution, okay, and mutual fund people. So either it's a domestic or foreign institutional investor, that is FII and DII, or brokers and retail investors, okay. So basically brokers and retail investors, okay, are likely to play in the option market, okay. So you understand why, okay. So you understand why I mentioned over here recently. If you see, okay, there was a video of Nirmala Sitharaman got viral, okay. She asked, is F&O really for a middle class, okay. That is the reason this concept, even this concept they given in the NISM series, okay. So this is the reason they asked the question, okay. So basically these people, only for these people they allowed, okay, they introduced the derivative contract, because they are basically they are the holders, major shareholders in some companies. So for a hedging purpose they use option. So that is the reason she asked this. So understand why she asked this, okay. So and the risk of an option buyer is, okay, basically when you are buying, okay, you only pay the premium. So that means to say only that premium you have a risk. So we are going to, okay, so this is very basic concept, okay, when it comes to option trading. And we are going to check what are the strategies and what is the time value and all this in upcoming videos. So this is what you want to know, okay, about the option contract. So this is the main important concept, okay. So this is what you want to know. So most probably in upcoming videos we will check it deep, okay. Thank you so much, have a great day.